All right, good afternoon, everybody. Welcome today. Glad to see everybody. Income trading with high volatility, and that's a good picture Johnny took of, it's like an old Jerry Lewis movie, but somebody biting their teeth like that and very nervous. And it can be spooky, let's face it. When you have 2 days of that type of volatility that we've had after 3 years or whatever of the market just going up, you know, most of you who are trading might not have ever lived through anything on the downside. It can be a little tough. I see a little comment there. I'm not seeing Jerry Lewis. Yeah, I didn't promise Jerry Lewis. You're seeing a cover page. The man on there biting his nails to me reminded me of Jerry Lewis, but is not Jerry Lewis. So to the Jerry Lewis family, I want to make sure they know that. Okay. All right. So let's dig in here. This is for educational purposes today. So what do we have here? As of, again, the market's moving around so fast, I'm not sure where SPX is at this second. As of 11:50 a.m. Central, a little over an hour ago, SPX was at 2707, up 12. And where's it at right now? Where's SPX right now? 2695. That's pretty amazing. I mean, that, you know, it's just moving all over the place. There's still not stability in the market, but let's talk. And let me just talk about this slide a little bit. So let's start out looking at the overall market. And the first thing is, did I know or did anybody else know when the market was going to go down? No, right? Some of you might tell me, and they might say, Dan, you know what? I told my wife the market was going down. Well, that's good. Maybe a couple of you take credit for it. I don't. But if there's anything that, you know, but if I were to say I had an idea it was going to be very volatile coming up, you know, what are some concrete things we can look at? That I can at least, you know, give you, my 2 cents on that. So if you look at this, if you look at the entire month of January, in the SPX, we had about 22 trading days. And on those 22 trading days, as we go right up to the end of January, right? If you look at January, you say, were there any signs in the January activity that we could be headed into a volatile time? And the answer is yes, right? And this was very similar to 2008. And the answer is, if you look, I think I had a slide on this, but I can't find it. But I think out of January, if you look at actual trading days, we're about 22 trading days. Out of those trading days, half of the trading days had moves in the SPX of 18 points, right? So 11 of the 22 trading days in January moved 18 points in the SPX, which was, depending on the volatility, almost a standard deviation and a half. So you say, well, what significance is that? So as a general statement, when you're seeing 2 out of 5 days or 3 out of 5 days where you're getting 18 points or more, or a standard deviation and a half move, which would be about 1% move or a little bit less in the SPX, when you start seeing speed, it's like a volcano starting to erupt. Usually it's a precursor of more volatility, very similar to 2008. Now, did I have any idea during January that we'd have the big down move? No, but I was pretty sure we were going to I was pretty confident from the speed, we were either going to have a correction or we were going to blow out to the upside. But we were usually this kind of speed, especially to the upside, because VIX didn't get much over 12 during January. I think at the end of January it finished at 13. But I think that's very important for you guys to keep an eye on the standard deviations, because you can't, when you think of speed to you think of volatility to the upside, you say, well, there is none. VIX is low. Well, that's why you have to watch the price action and volatility. So out of the half the days in January moved about 18 points, and only one of those days was a down move. Do you know that? Only one of the down days, or one of the days in January was a down day. So when you have this speed, it's a precursor of more volatility. And we were trying to take precautions before that, right? In terms of what adjustments we would use and what strategies and what duration. But we didn't know that was going to go. But we knew when you see that speed, it's usually a precursor of more volatility, and that's what we're in. It just so happened it went down. And so I think that's something concrete you can keep an eye on, is measure, and we're just talking close-to-close moves in the SPX on a daily basis. A more accurate measurement be where you take into account the highs and the lows, and that would be the average true range. But I think, you know, that is something you can monitor and keep track of that can be helpful to you. So that's a little bit on price movement in terms of things you can look at, right? Now, let me just say this, a couple other things that come to mind. You know, as I was reading yesterday, was it yesterday's Wall Street Journal talked about, you know, people 2 weeks ago saying inflation and all that when the market was going, you know, it was okay, inflation was good. And then yesterday or the day before, when they say the market's getting killed, it's because of inflation. In other words, the worst thing you could do is read the Financial Journal and see what, have their explanation of why we're going down. When I was at the CBOE, we'd have Reuters and Dow Jones calling us up every day saying, well, why is the market down today? They needed a reason, right? And to me, is there anybody here in this room over the last 3 months, if I would have called you up and said, hey, are we due for a correction? Would it surprise you if we went down? Every one of you would have said, hey, Dan, we're stinking due, right? We're due. But when it actually comes, it's spooky because of the speed of it, isn't it? And that's welcome to the downside. And you say, was this speed more than usual for the downside, especially the 116 days? I'd say a little bit, but when you look at the potential, when you look at the speed of January as we were going up, 18, up 18, up 18, up 18, up 18, you know, it's pulling that rubber band. So this kind of speed, it was like letting steam off. So anyways, that's a couple comments. The other thing is this. So I made a comment on, do I think there's something concrete that can help you guys in terms of when things are getting ready to explode, and we talked about that. The other thing, and I'll get to a question by Leanna in a second, the other thing I mentioned as far as don't get too caught up into why we're going down or up, right? We're going down because we've been going up a lot, and it's just normal with the markets. In terms of the reason, don't get into that. Now, if you said to me, what's my biggest concern? My biggest concern is execution. How many of you on, you know, the last 2 days, or especially the day we're down 116, or the day, any of these days, had trouble getting spreads filled? Did any of you notice that the prices fluctuated wildly on the spreads? Right? Did any of you notice that for spreads that it was a little difficult? And I'm saying that as an understatement. And you read in the Wall Street Journal, TD Ameritrade and other firms were having trouble. Now, you know, what tickles my soul is that these firms will say, I apologize, you know, for whatever, when I wish they'd just admit, you know, when we start moving 50, 60, 70, 80 points in the SPX, those type of moves, they're human, and their thinking computers can't handle it that well, right? You wish they'd come out and say it, but I think there's pride involved, and they don't want to admit that, you know, it can be tough, but that's costly, right? And I understand, and I'm not, you know, I don't blame them. I just wish they were honest, right? Because the problem is I had students trying to call in and they have really good profits on long puts and couldn't think and get out, some of them. Anyways, so those are more, my concern is more the execution. And I think that, as we were talking about in one of our sessions yesterday, when the VIX is between, you know, for these non-directional income trades that go both ways, when VIX kind of settles for a few days in that 20 to 24 area, that's fine, right? I mean, I see Rick Lee said he did an iron condor and he made some money on it. Yeah, and I think that's good. I think, you know, again, I don't know the logistics of what Rick did or whatever, but to do an iron condor at 17 and it goes down to 12, you know, I'd have to talk to Rick about it, but, you know, it's not always that easy just to sell high volatility, because SPX obviously moved up a lot, and some of that price move should hurt the trade. So I don't know if he was leaning long or short or whatever it was, but, you know, I'm looking more for two-way trades or spreads that have risk in both directions, like butterflies, iron condors, and calendars. I'm looking for VIX, and we talked about it yesterday, to be between 20 and 24 for a while. The mentors, Mark Fent and myself, were talking about this yesterday. Now, obviously, yesterday, for people doing put credit spreads and cash secured puts and covered rights and not long diagonals, but you know, put credit spreads, it was wonderful. Volatility went down and you had a bullish position. Anyways, so that's a few comments on that. VIX is 24 down 6. I don't know where it is right now. And, but, you know, things got way, you know, that, you know, on a day that it was down 116, or the market, it spooked a lot of people, right? And I think VIX just got way high, but that's the panic. And I think for a lot of you who have only been in the market the last 3 years and have been treated by an up market, slowly trending most of the time, and low volatility, this was unusual. And, you know, it doesn't happen every day, but this is what the downside's like at times, right? And it's just like you got to get used to a little bit driving in these weather conditions. So what I'm going to look at today is just talk about some, you know, 2 or 3 or 4 strategies. I would say at least one of the 4. Most of you do some of these strategies, and just talk about them in lieu of the high volatility or the volatile environment, right? Here's just an example. Mark says better to watch VIX or VIX futures. I think you watch both of them, but I mean, they're just indicators, you know, but I would watch both of them. I mainly just watch VIX. I mean, it just kind of gives me a level of the volatility in the market. Anyway, so here's an example in Facebook. I looked at it a little bit ago. Facebook was $181.96, down $3.35. So down about $14 off their highs in the last week of $195. So how many people would say, hey, Dan, I like Facebook over the next year? How many of you would say, I like Facebook over the next year at this 180, 181 level? Anybody? Any of you out there that like Facebook over the next year? You think it'll be higher than 181 over the next year? Anybody? Anybody? Isn't that interesting? When the market's down, nobody will say yes. Okay, we got a few, right? You're scared. All right, a couple come in, right? All right, there you go. So if we look at Facebook and we say, so I'm going to give you a strategy. We're going to talk about a few strategies to start out with for the long portfolio. So I break an options portfolio into 3 divisions: long portfolio strategies, income strategies, and spec. So I'm going to give 1 or 2 long portfolio and 1 or 2 income today, and we'll talk about them in lieu of the craziness and the high volatility. So first I'm going to talk about a long portfolio strategy. and you say, hey, Dan, what's a long portfolio strategy, right? That's one, on a $100,000 portfolio, I might put, depending on the levels of the VIX and the price levels of the market, anywhere from 30 to 50% of a $100,000 portfolio into long portfolio strategies. I'd pick one or two. There's a bunch of them. But what is a long portfolio strategy? It's something that is neutral to bullish, something that either has no risk on the upside or just profits on the upside, or small risk on the upside relative to the downside. But it's something that generally should do well on the upside, right? What would be long portfolio strategies? Put credit spread, covered right, cash secured put, long diagonal, where you like buy in the money call 90 or 100 days out or further and sell an out of the money call against it. Out of the money put broken wing butterfly would be a long portfolio strategy because it has like 4 times less risk on the upside than the downside. So anything that has either a strategy that has dramatically less risk on the upside versus the downside, or does nothing but make money on the upside. Is that kind of clear? For a long portfolio strategy, you're neutral to bullish. Does that make sense? So those strategies, here's an example of one. Cash secured put. So here's how I would do, here's an example of a cash secured put. That'd be an alternative to a short put in an IRA. Because in an IRA, can you do a cash secured put in an IRA? Yes or no? In your retirement account, can you do a cash secured put? Which is the same thing as a covered right. Some say yes, some say no. Lots say yes. But let me ask you a question. If you sell a cash secured put in a retirement account, does it cost you a little bit of money or a lot? Does it cost you a little bit of money or a lot? The answer is a lot. And so your yields are going to be low, right? The most you can make is what? Maybe 1.5% a month, right? So what's an alternative? In my opinion, what's a much better way of doing a cash secured put in a retirement account that'll leave a lot of money back in your bank account? So I would call it a wide put credit spread, and I'm just giving you an example of one in Facebook today, okay? So there's how I would structure it. So Facebook, when I looked at it, is 180, 170. What's it now? Is it pretty close to here? I took this example a little over an hour ago. Is Facebook around 182 level still? Okay, so we're in the ballpark. Thanks, guys. So around 182-ish, 180, 170. So here's an example. I look and I say, you know what, with Facebook at 180, 170, it's come from 195. How about if I sold the 170 put, which has I think I sold this, it had a delta of 20, the short put. I sold it for $2.10. That would be a typical cash secured put. Do you agree? With Facebook around 182, you'd go sell the 170 put for, it's around $2. And the idea is, hey, if I get assigned on the short put, this is a 30-day trade. If I get assigned on this put, I got to buy Facebook at $168, right? Which is about $14 lower than the current price, or it's a mechanism to buy stock 7% lower than it is today, right? Right, so we've gone from what, 195 in Facebook in the last week to 181, and now we're creating a mechanism that we could buy stock 7% lower at 168. Cash secured just means, Robert, that you got enough dough in your bank account to buy the stock. Agree? You have enough money in your account to buy the stock. Okay? That's all it means. But the bottom line is, if you have to buy the stock, what's 100 shares of Facebook going to cost you at $182? It's going to cost you $18,200 for 100 shares. Good grief, Charlie Brown. So instead of selling a put at the $2 range and paying the astronomical margins to maybe make a half of 1% or 1%, I'm going to go and buy a put against it at about 15% of the price of my put. So you take $2 times 15% is about 30. So I go and buy a put for about 15% the value of the one I'm selling, and that's called a wide put credit spread. So in this case, I'm selling a wide put credit spread for $1.80, and instead of putting up a bushel basket of money, right, to either buy the stock or sell a cash secured put, I'm putting up the difference in the strikes, 2,000 minus my credit of 180. My margin or my risk or my capital that I have to put up is 1,820. And so if you look at, here's a graph on, I'm using TD Ameritrade here at Thinkorswim. This is your expiration graph here. The purple graph is the graph today. So with the price at 180.170, I'm selling the 170 put way out here. But if you look at the profit along this expiration graph on top, it's the credit 180 divided by your risk or capital you have to put up or margin of 1820. So this expiration yields about 10%. Out of that 10%, maybe I'm looking to make maybe 70% of it, but it's still a lot better potential yield and less capital than a cash secured put. Any questions on that? So, but again, so here's the idea with the long portfolio. You'd say, hey, Dan, would you put a trade like this on today? Here's the answer. How many of you do strategies that I would consider in the long portfolio? Yes or no? How many of you do some of the strategies that I mentioned that are in the long portfolio? Cash secured put, covered right, put credit spread, out of the money, put broken wing butterfly that has 3-4 times less risk on the upside, those type of things. Yeah, so here's the question. Why do you do those? People do those strategies because they may be neutral or bullish, right? They want something a little longer, you know, you're leaning a little bit longer, or we would say an options longer delta. So if I have X amount of dollars on a $100,000 portfolio, let's say 40 grand allocated to that, well, I'm going to pick one or two of those strategies and allocate some capital to that, right? And so when you have, but in the long portfolio, if I have a plan, right? These are the stocks I'd like to do it in. These are the indexes. When the market's down 7 or 8%, I mean, the market from the highs of the year about a year ago to the low when the day we were down 118, we were down about 9%, right? The highs on January 26th were 28.72. The low on February 6th, yesterday, was 25.93. That's 9.7% down. So in the long portfolio, if you're looking longer term perspective and you're saying, hey, I like Facebook over the next year. I like the market over the next year. That's how you are in this long portfolio. It's easier to jump in some. Does that make sense? So here's an example of a long portfolio strategy, a cash secured put, that would be very favorable today. You'd say, why would it be favorable? Volatilities are higher. Stocks are a lot lower than they were a couple weeks ago. And if you're putting on long portfolio strategies, you know, this is your time, my friend, right? I mean, this is your time. You would be interested because you're more of a longer-term bullish perspective. In terms of width, you could go narrower width if you like. I'm just saying I'm just giving you a general guideline how I do it, right? I might sell a 20 delta put, and then I'm buying something maybe 15% of the value of my short put against it. And you can do it in SPY, you can do it in any vehicle, right? But again, here's the premise that you need to have, so you don't get scared out of your thing. If Jim Newman says, would you do this in SPY? And the answer is yes. But the answer is this: I'm looking at it over the next year. If SPY goes down tomorrow, I'm not going to just, I want out. I'm looking to do this every month, right? This is my long portfolio strategies that I'd be doing on a regular basis. So anyways, let's look at another long portfolio strategy. A put credit spread is a long portfolio strategy. Dan, why is a put credit spread a long portfolio strategy? Well, here we're at 2704, and here's the expiration graph. A lot of risk on the downside, no risk if we're down a little bit, if we're neutral, or if we're up, right? So a put credit spread is a long portfolio strategy because it makes money on the upside. It doesn't lose money on the upside. It's bullish, right? Here's an example of one. Now, what's the difference between doing a put credit spread today versus 2 weeks ago when VIX was 11 or 10 or 12? The difference is your credit doesn't change dramatically. You might get a little more credit, but the distance away from the current price is dramatic. So, for example, here's a put credit spread I took in the last hour. Sell 1 March 9, that's 30 days out, 25.60 put. And buy 1 March 9, 25.50 put. It's a 10 wide put credit spread for $1. In an 11 vol environment, if I sell a put credit spread where my short put, where I'm looking to sell a strike around a 20 delta, that just gives me like about an 80% probability credit spread because there's only a 20% probability we're going to finish below 25.60 in 30 days. Can it happen? Of course, but that's what it means. That's why I would say it'd be an 80% probability credit spread when I sell a 20 delta. Now, if you look at a 20 delta put credit spread today with the VIX at 24, I'm getting 144 points out of the money from the current price. When the VIX was 9 or 10, maybe you get 70 points out of the money. So what's the advantage of doing a put credit spread when the vols are higher? The pluses and the strengths are you get a lot more distance, maybe a little bit more credit, but what's the negative of putting a put credit spread on? When the market's down and the vols are up, you're a little more scared. Agree? You're a little more scared. The best way to gauge your risk is just, to me, look at the spread, right? If I'm doing 1 put credit spread, I've got $1,000 of risk if it's 10 wide, less my credit of $100 is $900. So you know who's the best person in the world to tell me how much risk I should take? Myself, right? Right? I look at my portfolio, how much, so obviously it has to do with what's my allocation. What's my allocation on a 100 grand portfolio or a 10 grand portfolio? What am I allocating to long portfolio strategies like a put credit spread, right? I can see my risk is $900. So if I want to allocate 5 grand to put credit spreads, then I do about 5 contracts. Let's remember when we're doing a high probability put credit spread like this, when you get high probabilities, you get stinky risk reward. If you want a better risk reward, you're going to have to sell a lower delta put, right? You can't have your cake and eat it too. So this is an 80% probability credit spread when you're doing a 20 delta. So I'm selling it, I'm bringing in $1 credit to lose. What can I lose if it goes again? If the market collapses, I could lose $9. So I have a 9-to-1 risk reward. Does that make it a good or bad trade? No, what makes it a good or bad trade is how I manage it. Now, if I sell it for $1, probably from a plan purpose, if I'm trying to make $1, right, and my margin is 900, so the most potential yield I can make on that expiration is the $100 divided by $900, be about 11%. So my expiration yield is 11 if I hold it till expiration. So in this case, what would I probably do, since there's only 11% potential, but I've got a lot of room here, I'd be looking to make about 7%, right? I'd look to make 7%, which would be about 2/3 of my credit. And the most I'd be willing to lose would be 2 times what I'm trying to make, or 14%. So in this case, for every one contract, if I'm looking to make 7% on 900, it's going to be close to $60, $65 profit for every one contract I do. And if it goes against me, I don't want to lose more than $120. So for a profit, if I sell it for $1 credit, I'm going to buy it back for 35 or 40-cent debit. But if it goes against me, if the market tanks some more, at $1 credit, when it gets, is it easy? You say, well, Dan, I back tested, or Dan, I've paper traded, blah, blah, blah. When we're down 116 points, how easy do you think it is to get off your credit spread? And that's what people in the world of back testing or the world of credit spread systems fail to realize, that the world's not like Walt Disney, right? And it isn't easy to get out of credit spreads when the market's cutting loose, when we're moving over 50 points in the SPX. All right, let's move on. Now I'm going to get into two strategies that have some risk in both directions, and this would be the income part of the portfolio. And real quick, I just want to mention that a week from yesterday, Tuesday, we start a double calendar class. You can get some information on our website. It's a 2-3-week class, twice a week, that'll go for $297. And it's going to be on, because of the volatile market, I've tweaked it. I have the topic double calendars, which has been a great strategy in our community over the last 4 or 5 months. But I'm going to combine that. A double calendar is an iron condor alternative. So we're going to go back and forth with these double calendars and iron condors. They're very similar. They're both selling out of the money call and put. And so I'm going to be putting both of these on and talking about them. I think it'll be a very interesting class dealing with these strategies that are basically selling out of the money calls and puts, like double calendars and iron condors, and how we would trade them in a volatile market. And so that should be a very interesting class. It'll start, so the class is double calendars, but because of the wildness and the change in the market, I'm bringing in another strategy, and we're going to go back and forth. It should be interesting. All right, so here's another strategy. Here's another strategy for income. And again, we look at an iron condor. Iron condor 30 days out with VIX 24 today. So with SPX at, SPX at 2708, when I took this example, this would be a traditional iron condor, where the delta of the short call and the delta of the short put are both, you can pick your delta, but here I did 12. So it's pretty far out of the money. And the way you get your probabilities is add the two up and subtract from 100. And that would get you 24 from 100 would be 86. So this would be high probability, about 86% probability iron condor. Again, I'm selling an out of the money call, in this case the 2850 call with SPX at 2708. So my out of the money call is going to be approximately 140 points out of the money, and then the out of the money put 2470 would be about 238, almost 240 points out of the money. So what's the lesson here? When you do a traditional iron condor, Dan, what's a traditional iron condor? A traditional iron condor is where you pick your short strike by selling the same delta. So I can do a 12 delta call and a 12 delta put, or a 15 delta call and a 15 delta put, or a 5 delta call and a 5 delta put, or a 20 delta call and a 20 delta put. And so when I do these, a traditional iron condor is going to give you about 2 times the room on the downside as the upside. What do I mean? Or some percentage of that. On the 12 delta call on the upside, I'm about 140 points away from the price when I did this. On the short put, 2470, I'm about 240 points out of the money. So if this is the underlying, you can see a lot less room on the upside, a lot more room on the downside. So when we're in a high volatile high VIX environment like this, after the market's gone down, I'd favor a traditional iron condor versus other types of iron condors, maybe where I'm doing a different delta for the call and put. So the Greeks would be a little bit short 1 delta for every 1 contract, a little bit of positive theta, short vega. So that would be an iron condor. That would be an income strategy. Income strategies would have some risk in both directions. Generally, income strategies are going to be higher yield than the long portfolio strategies, but you're going to have risk in both directions, right? Versus a put credit spread is a half of an iron condor, but you're going to make higher yields generally in this because you're selling the call and the put. All right, any questions on iron condors in a little higher volatility environment? But, you know, generally good higher volatility environment you'd like for iron condors, but you don't want it too crazy, right? Because if it's too crazy, you can't get good execution. And the other thing is when the volatility comes down, if the market goes up, you could get, you know, the price move could offset the volatility reduction. Robert, what do you mean? What's my rule of thumb for downside delta? Are you looking at what are you looking at adjustments? Are you looking at initiating a position? What is the short put or what? I'm not sure. Maybe give me a little more information. But anyways, here's an example of an iron condor, and that's the benefit right now. If we can stabilize this 22, 24 area, you're getting a lot more room on your iron condors, right? And I think that's a decent opportunity. I mean, it depends on the iron condor. Sometimes I can initiate the iron condors with a 10 delta or 20 delta. It all depends. But this is just one in this current environment. This would be called a high probability traditional iron condor, and it's giving me a lot of room, which people like in this environment, and a little more credit than I would in an 11 volatility environment. There's no optimum, Leanna. Remember, people will say a 45-day duration is better than a 20-day duration. Some people will say a 70-day duration is better than a 40-day. Here's the answer. Here's the answer. There isn't one better. No, I mean, some I might say better, but there's a plus and a minus, right? You know, is a 45-day iron condor better than a 20-day? No, there's pluses and minuses. A 20-day iron condor has a lot more positive theta, which means you could get out of the trade quicker, right? And if you could get out of a trade quicker, might you avoid a big move? Yeah. So it's not a slam dunk to say, well, a 45-day trade or a 40-day trade is more optimum. No, it's not. It's not, right? It's not. Right now with the volatilities higher, would I go a little bit further out on the iron condors? Yes, we weren't doing iron condors before. We weren't doing iron condors for the last 3-4 months because the VIX was so low. We were doing iron condor alternatives, double calendars. But now that VIX is up, I don't have any problem doing iron condors on a regular basis as long as we get some stability in the market yet. And just because we're stable today, that's not enough, right? We need a couple days of a little more stability. But I would like to go, because the volatility is higher, I can go out 30 days. I'd probably go 30 to 40 days, and I can get more time premium because of the higher volatilities that make sense to me, right? For the last 5 months, I wouldn't do anything in iron condor more than 10 days. Why? It wasn't worth it. You know, the theta you got for a 30, 40, 50-day trade was disgusting. All right, let's finish with one more income trade, and this is the type of trade that we'll be talking about in the double calendar class next week, as well as iron condor. So it should be neat. Two strategies for the price of one. All right, so here's an income trade double calendar. This would be an example of one that I was doing over the last 4 or 5 months. Again, in our community, we're kind of just sitting on the sidelines a little bit for a lot of these trades, just waiting for a little more stability or trading small. I mean, there's nothing wrong with trading smaller in this till we get a little more stability, because when things get crazy, execution stinks. So here's an example of a double calendar, which is an iron condor alternative. We're selling an out-of-the-money call. We're selling an out-of-the-money put. Again, my short duration is 9 days out. So with SPX at 2709, when I was looking about an hour ago, I'm going into the Feb 16 expiration that expires in 9 days. That's a week from this coming Friday. And I'm selling the 2745 calls. It's about 35 points up. And then I'm selling the 2670 puts about 40 points down, right? From this current price around 2709. So selling an out of the money call and put, that's the exact foundation of a iron condor. Andrew says he doesn't see the slide. Are you guys seeing the slide that says income double calendar? Yes? Okay, so you guys are seeing it. And so this is a trade. Why do I call it income? Isn't the long portfolio income? It is, but these are trades that are generally higher yield potential than the long portfolio, but they've got risk on both sides. And so here I'm buying a 23-day option. I'm buying the March 2nd duration, and I'm selling the Feb 16. Again, I'm about 35 points out of the money on the upside, and I'm about 40 points out of the money on the downside. Now, this is a long Vega strategy that could lose money if the volatility comes down, but you might say, hey, Dan, how do you, like David says, hey, Dan, with a Vega positive trade, how do you feel about doing a double calendar in this higher vol environment? Here's my answer. If my shorts are, 14 days or under, I got no problem, right? I got no problem. You say, why? And this goes to the next question. Robert's saying, isn't the rule of thumb that calendars are bad in volatile markets? But here's the key. Are all calendars created equal? With the rules in the Geneva Convention, can I do calendars any way I want? In the Geneva Convention says, can I do calendars where my short options are 9 days from expiration? Let's look at the Greeks. So here's my Greeks, and here's why I'm not scared of the big bad wolf, higher volatility. I'm scared of price movement, but I'm not scared of the big bad wolf. Here's why. We're at 2709. I'm 2 deltas long. The big bad wolf of long Vega is 201, but let's look at this, darling. My theta is 128. My theta is big enough, like a Sugar Ray Leonard, boom, boom, to fight the Vega. When you do a 30 to 60 day double calendar or a 30 to 60 day iron condor, your theta is a paltry 5 or 6 or 7. Yeah. But when I'm doing these short-term trades, my theta is big enough to punch the Vega right in the kisser, right? But the price movement is crazy. So right now, am I jumping in both feet to do any income trade with risk in both? No, we're letting things stable, right? Right? We're letting things stabilize, right? I'll use a bad analogy with you. Anybody ever go deer hunting? I never went deer hunting, right? But if you've ever gone deer hunting, tell me if this is true. If you shoot a deer, could it take a while for the deer to drop? Are they still moving around, and can they be dangerous? If the minute you shot the deer, if you told your son immediately go near the deer and pet him, would that be wise? Yes or no? Jim says it would be wise. No, maybe he's not dead yet. The point is, right now with the way the market's going, we're waiting for a little stability in the VIX and the market. We're scared of the execution. I don't mind doing a double calendar right now if I could be assured good execution, but I'm not. I want a little more stability so that we're just kind of pausing. But that's an example. So why am I not afraid Now, would I be afraid? Would I be doing a calendar where my short is 30 days out and my long is 60? I wouldn't be as crazy about doing it, right? But I would do it in certain circumstances. So again, it's really how you trade it. All right. So folks, that's a couple questions here. But again, next Tuesday we'll be focusing on the class for 3 weeks. It'll be about 6 to 9 hours of live content, and I'll be going, because of the high vol environment, I'll be going back and forth with double calendars, iron condors, and I'll probably put 1 to 2 live trades on every class. We'll follow through from beginning to end to show you how to do this. Robert says, if you could choose one strategy, would it be the iron condor? No. And I'm really, and I'm not trying to avoid, I'm not trying to be a politician and avoid it, but I don't do that. In other words, in terms of the market conditions, for example, if you ask me September, October, November, December, what was my favorite strategy? Double calendars. I still like them, but that was the favorite. If you ask me, hey, Dan, from January to September 2017, from the end of February 2017 to the beginning of September 2017 for 7 months, and we had a slowly uptrending SPX, where SPX was in a 200, 250-point range for 7 months. You say, what did you like? These out-of-the-money put broken wing butterflies and other strategies, those were the favorite. But the weather changed a little bit in September. So what do I base my best or favorite strategy on? I'm constantly looking at the weather conditions, price levels of SPX, the volatility levels, and the speed of the market. And that's how we kind of navigate and tweak, and we're able to trade these different strategies through different weather conditions. Double diagonals are a little more flexible than iron condors. And anyways, well, thanks, everybody. I appreciate you coming in today. I look forward to the class starting next Tuesday. And if you have any questions on the material today, feel free to email me at dan@sheridanmentoring.com. Have a great day. Thanks.